Most traders guess.
We know.
Reaction is for retail. Anticipation is for architects.
This is your crystal ball.
Okay, now it's working. Perfect. Okay. Hello everyone. Anyone listening to me, I'm assuming I'm speaking to the people on the west side, so I'll say good afternoon, but I'm actually speaking it from the west side, which is India, so where it's actually like almost midnight. So today, like right now, it was not something I was planning to do something, but something really interesting that came along around my desk, and I thought it would be interesting to sort of like share with you guys what am I seeing. Okay, so there's this one thing, you know how on the west side we have the SEC. Now on in this side we have the SEBI, so we call it like SEBI, right? Essentially, their job is to exactly what the SEC does, but then they really go hard. When I say this, like I really mean it. They really crack down if you're a big hedge fund, or they really go after like even YouTubers. So I was on there's few people that I follow, and then I saw their accounts being shut down. They have this thing going on, something called it's a collaboration with YouTube where they're really cracking it down. People who are who are misusing being a content creator / educator, and then they tend to start giving basically like some sort of in shape form where they're literally giving you like ideas, and they can interpret it in any way. So I'm really trying my best. Like for example, I looked at some of the things that I say. For example, like you might see that there's a word called Jane Street Flow Tracker, right? So although I already made a public like an announcement about this, but I also mentioned in the announcement that I would need like at least 30 days because I've used this name freaking so much, like literally on every thing that I produce, I have this name attached. So of course it will take some time. Like I'm a one-man army sort of a person, so it will get removed. So solely because of that, I won't be able to exactly show you on the screen until it gets done. Like the rule is, if you are an educator, if you're just creating a content, the things needs to be at least 24-hour delayed. Like you cannot talk anything about like in real time. So what we're gonna do is it's a kind of a conflict between how would you then prove your model if you cannot even show it in real time. So what we're gonna do is we will rather just look at it as what the model is seeing. I'll walk you through the process, and as I'm live, right, once it gets done, the market is closed, I'll be able to like show you, right, because that's allowed. But instead of just showing you that, I'll walk you through like how did my model actually came to that conclusion. Okay, so just a few I think an hour ago or so, I mentioned about there is some headline driven thing coming out, right? So hopefully we will be talking. So I think by the time hopefully it gets out, so we'll be able to like see. Let me just quickly get on my screen. This is okay. Okay. Wow. I'm actually up since like 2:30 a.m. So my eyes kind of looking very red. I can see myself on my top screen. So I'm like, wow. Okay. So what I want to talk about is I want to start my conversation over here. This is one of the things that I posted back in October, right? Well, I publicly talked about it back in October, but honestly, it is, if you click it on the links, you will see it was posted like years ago, like literally years ago. This is from 15th July 2024. We'll come back on this one in just a minute, but as you know, like right now we just had the Fed on, I think on Wednesday, where there was at least the consensus have built on this assumption that the rate cuts are not happening, or at least there's no rush to do so, right? So you're seeing SOFR rates going up. Well, 2 years really not doing anything since like October meeting. For example, if you'll see this one, this chart literally posted a year ago, okay, when the 2-year was trading like around 4.283. Okay, now I want to bring you look at, we're here right now. Like this is exactly where we are right now as we speak. Like I just took the screenshot like 2 minutes ago, like just a few minutes ago. So this is what I posted. This is, so okay, understand this. I first made this back in January 19, 2025. I publicly talked about it. I literally posted on my X back in October. So it was like right there, like around somewhere around there. And now, as we speak right now, today's what, January 30th? We're almost on a blink. Okay, we're like literally right there. Okay. Now, why, who, where? So what we're gonna do is we'll be talking about how does this model figure out these type of things, and what is that path that will take us to 3%. There's already a lot of debate. There are people who favor rate cuts. There's people who would, favor we should not cut the rates, right? So there's a lot of debates already out there. I'll walk you through how does my model understand and like kind of digest all of this. So that's number one. Number two, what we're gonna do is this is, again, we'll go back to the X, and then this chart again posted back in 15th October, like before even Trump took office. Okay, and this is what I posted when it was somewhere around 4.61. And now as we speak, by the way, there's actually, you can click it on, these are not just screenshots, you can actually look into all these things. Like there's literally a link, you can click on it and then you can see they're not some AI edited, these type of some fuckery I should say. I truly believe that the trading view links are the most transparent, most accurate, because once you create that, no matter what, you cannot do anything. Okay, it just like it's just in the server, nobody can edit it, right? So you can click on it, right? And now as we speak, we're like literally right here. It's like, I don't know if you can see my arrow, but like literally right there. Okay, so I personally, yes, I am long bonds, and not just like now. I think I've been long since just the start of the week. So I'm long futures. Just so you know. Also another disclaimer: when people join, the whole community, they pay for the data. Okay, whatever I say, it is my own opinion. I'm also a subscriber to the model, so whatever I say, I'm basically, disclosing what I am doing. But people, when people join, they pay for the service to get the data. Now, the model does not give you buy or sell. It is on you how what you want to do with that information. It will never give you any buy or sell. Now, me as a creator / educator, my job is to basically show you how I use it. Now, there's no universal rule that this is the only way you need to use it. I just show you a perspective how I personally use that. Okay, so just so you know. So this is we got 2 year, we got 10 year now. What really got me interesting is this shit started taking over. Okay, so this is not even a year ago. I first well, this is just well, actually this is just I just posted it, but I'll show you from my X post. Okay, here we go. So do we have original one? Let me see. This is from October 29th, so this is not original. Oh, well, it is original, it's just not an updated one. I don't have a, so here's the thing. Back in 2024, AI was not a big deal, right? So I would not get any sort of like a pushback on whether am I legit or not. People would just randomly, or at least they will have more sympathy towards, you know, attacking me on like, oh, these are just the pictures, you can edit it, right? Of course, in 2025, AI become a thing. People could actually create these things. Since then, I started publishing not just the just like a screenshot, but actually the link, right? So yes, in certain case, for example, this chart is actually from like early 2024. So I don't have the link. What I can show you is I can walk you through where it was posted. Like for example, like I have a, you know, I have a Discord community. That's where actually when you will join, you'll be coming into that, so you can actually scroll to that conversation, right? Because I've been running the Discord since COVID now, right? So everything's there, right? Just so you know. But when it comes to few assets or few, let's say, like, you know, things like one of these chart, I don't have a link. I can share the message link that will, you know, it will take you to the Discord where it was actually posted. But so this is actually from 2024, and now look at where are we right now. Where is it? Boom. I'm like, wow. Okay, so this is going to be interesting because there is going to be okay, so there's a lead and lag between how things translate into these. First of all, this is an inflation swap. This is a financial product. This is not like a tradable thing, right? It's more of a if you would want to trade this, I think you would have to go through the tips market. So point being, it is a financial product. It's a swap between two parties, right? Give me just one sec. So although I am seeing treasury yields, both 2-year, 10-year going down, which is going to fuel inflation swap to the upside, but when those things are going down, this will also come back down. So you could basically expect this going into like a sideways thing, and once the treasury yields hits the rock bottom, which is 2-year can go through 3%, 10-year can be around 3.60, which is quite like a lot, almost 80 basis point from 4.20 to 365, almost 80 basis point on 10-year. 2-year can go almost 40 to 50 basis point where it currently trades. So it's a big move. Okay, so until then, this can just like chop, it can pull it back. It will basically be just going on sideways. And I think once that, you know, the yields gets to the 2 and the 10s gets to the level that I just mentioned, I think that's when this really takes off, right? Because you'll be when you cut the rates, I'm assuming there will be some shape or form of a QE happening. They may not use that name, but it is essentially you are providing the liquidity, right? And then of course we are in a midterm election, so there could be a fiscal approach coming in. Now these are all speculation, right? So now I'll explain you how how my model sees things, like how does it understand these type of things. So if you have not watched my when I first launched, because I first launched the framework in with the US market back in January, I strongly suggest you should watch that, because it has a specific explanation on what the framework is. Because I may not be able to go on each little thing, because it's a complete different conversation. It takes a lot of time to explain. So if you feel like, oh, where am I in the conversation, I would suggest you should go back there. But I will try my best to at least give you a surface level understanding, so you're not absolutely confused. So this is the dashboard. And so first of all, if you're new to this, crystal ball is like, think of it like this. Let me actually pull a, give me just one sec. Okay, so this image perfectly explains what am I trying to say. So most people, right, if you are a person who looks at the chart, so a technical person, doesn't matter what strategy, if you are looking at chart, you are a technical person. If you are running an algo which is based upon some sort or a shape or form of open interest or price action, same thing. Even if you're looking at earnings, the fundamental analysts or value investors, if you're looking at any sort of those things, still outdated, unless of course the forward guidance is the only thing in that piece that gives you a sort of a futuristic forward-looking view. But still majority of things are outdated, right? So point being, if you look at the left side of the section, this image, what happens is most people wait for the tire prints. So think of it like the bank being the car. Okay, so when the car is moving, there is the tire prints that are taking place because the bank is doing something. You will not know until they have already made the move. So when people try to, for example, on Sunday, apparently Indian markets will be open. We have like a fiscal budget coming up on a Sunday, so it will be a full flex day. Now most people are talking, debating what the budget will do, as if market have not already decided what it will do. To make it even more simpler, what I mean by this is most people associate the price action is a root cause on what is happening. And then they start looking for, the news, the headlines, and whatever they can find to justify why it is happening. What I am saying, whatever is happening today, it was decided days ago, maybe weeks ago, even in some cases freaking years ago. How? I just showed you. I literally just showed you. It was okay. So I know if you guys do not trade any sort of like treasuries and this and that, okay, no problem. Do you trade S&P 500? Okay, look at the chart. Do you trade NASDAQ? Do you trade Nvidia? I mean, I can just go on like so. I can give you so many examples. And it does not matter what you trade. Point being, if you're associating price action is the root cause, and then you start, because you have to understand the framework. What happens is when something happens in the market, right? When people are relying on the price action. So price action can be very confusing. There's a thing that buy the rumor, sell the fact. Okay, then there's a thing that sometimes market just do it what it wants to, right? Sometimes you will see some large moves are happening without any news, because what is happening is when you're relying on the tire prints, okay, let me just use a metaphor. Imagine a bank is a car. Now, imagine if the car wants to move from, let's say, New York to LA. Okay, it's a freaking 32 hours long drive. So when it wants to move from one place to the LA, which is the destination, first of all, how would you know what car is it? Is it like a Toyota, a Honda, a freaking Rolls Royce? Like how? Is it even a truck? Right? You will never know. Second, at what point that car will fill the gas? What if they get into an accident? What if they have to take a detour? Like, how will you know all of this? And that's why 9 out of 10 people lose money, because you're adding more and more variables onto you and your success. Like, in my opinion, I think betting on a ruler or any sort of like casino might give you better odds. So what I'm trying to show you is, instead of focusing on the tire prints, why not just focusing on the car's navigation system? And that's when the GPS, this model comes in. We don't predict the market. What we do is basically we sit at the back seat, we look at the people who are driving the market, and we just like monitor. So when I show you a chart, don't literally take it as like it's a prediction. It is a navigation system with a surveillance that offers you every day, every week, every month, every quarter, every freaking year. So you need to be in the ecosystem. It doesn't matter what the long-term model says. You still need the access to the other things, because I'll tell you what. Imagine a situation, if I'm driving from New York to LA, 32-hour ride, okay? What if in the middle of that, my mom's called me and be like, can you just pick up my friend? You know, or aunts, let's say. Let's not make it complicated. Let's say she calls me like, you know, can you pick up, you know, and like bring us to the LA. That means there's an addition route I need to go through. That means extra fuel. There will be an extra passenger coming, and then I have to make a different detour. The structure is still the same. The destination is still the same, but there's a shift in my overall my route. So the Google Maps automatically will update the timing, the route, and of course I would have to pay the extra fuel, right? Now, would you blame Google Maps? Like, how the hell why am I not reached in 32 hours? Is it Google Maps mistake that suddenly your mom called you and then you had to take a detour and then you had to go to some other place and somebody else wanted to join you? Obviously not. And that's exactly what happens with this model. Is if you see something on the chart, let's say publicly, there's a chart, there's so many charts, which is, you know, for people can actually see, and they're not even done yet. Remember, there's other things that you cannot see it. So when you're looking at this framework from a lens of it's predicting something, obviously sometimes you will feel it is working, it is not working, because you're looking at it as it is trying to predict something. No, it's trying to lay down a structure. Now the structure can change many times, and that's why the navigation part comes. You have to distinguish a signal thing to a 24/7 surveillance thing. Meaning, a prediction is when people try to predict something that they're not even being a part of, which is they're not the bank. They do not have any influence on the bank who moves the market. So when you cannot control the market, you're not even the bank, you have no influence on the bank, why are you trying to predict them when you're not them? My question is that. So what I try to do is I do not try to predict anything. I try to just look at what the hell they're doing. That is it. So if they choose to drive, I'm watching them. If they choose to not drive, I'm stepping back. If they choose to go in circles, I am going in circles with them. That's the whole idea or the philosophy you can think of what's in the framework. So now, so you know the basic, what's in the framework. Now, what we do is, what you're basically seeing on this section, there's a lot of information. Okay, so I get it. You might feel very overwhelmed, but what we have to focus is on three things. Number one, I just showed you that Wednesday we've had the FOMC. Most consensus, even the financial products like the SOFR, like the SOFR rates, they all are, pushing back towards if the rate cuts are coming anytime soon. There's a consensus build up that the rate cuts are not happening until June 2026, right? That's the consensus. My model is completely making a contradictory observation. So that's number one. Number two, what will get us to the 3% on 2 year, 3.60 on 10 year? Like what does the path look like? Okay, so imagine Bombay, New York to LA is the goal. So think of it like 2-year is currently trading around 3 point something, and it wants to go to 3%, right? Now what we'll be doing is, what is the path that take us to 3%, and what are the, let's say, obstacles or hurdles potentially can have on the ride. So that's the second and third, basically the thing. Okay, so first of all, this framework gets updated on a day-to-day basis. Okay, so that's why you'll see there's a daily log, there's a weekly log, there's a monthly log. Now I won't be able to go through each one of them because they all require a lot of sort of breaking it down. What I'm going to do is specifically talk about what are the main factors that's actually driving and what people are thinking it is happening versus what is truly happening. So before I talk about this, I actually want to give you a little bit of like a system guide. In the crystal balls framework, okay, we don't believe or even consider that price action is the root cause for anything that's happening in the market, right? What we believe, according to the framework, which is proven, it's not the price action that moves. Price action is the last, let's say a thing to validate somebody did something. So that's the validation. It is not the root cause. It's like you pay the bill in a restaurant because you ate the food, not like you don't go to a restaurant to, let's say, have a mouth freshener. You go to get a freaking meal or the main course. The mouth freshener is just the last thing that comes along with the check. But people treat the mouth fresheners as if like that's the main thing. That's why I'm going. That's my main course meal. So what I'm saying is the main course is essentially the pressure. Now, when I say pressure, don't just think pressure means negative. Just because of the word pressure. Pressure can explode on both the side. Now, I'll give you an example. A good pressure is, let's say, in the short term, right? There's a belief, okay? There's a belief that when Trump took over Venezuela, the belief is that they're gonna get the cheaper oil, but the reality is they will take at least 10 years to basically bring back all their oil flows up to 3 million barrels per day, right? Now that's gonna happen in 10 years, and then the Chevron literally said, what if country go on a ride? Like right now, sure, you are here for the next 3 years, but then what is the guarantee that people do not attack you? So they've been betrayed before, right? The reason why they do not hold the power into that country, because back then when the US built all of these things, when everything was working fine, the political power came along. They just pressured all these private companies from the US to just pay us X amount or just get lost. So what if it happens again? Like as being a CEO, what is the guarantee that I will have full safety of me, my employees and everyone? What if I build everything and then eventually later down the line, I may have to again give up? So that's a constraint, right? So in the near term, okay, let me give you a stimulated, a situation, because I really cannot think of a good pressure as of right now. And I don't want to use the Indian example. You might get confused. A good stimulated example would be, let's say you hear a news, let's say Trump announces that how he announced that there will be a cap on credit card interest rates up to at 10%. Imagine a situation if he announced like, okay, in the US, oil cannot go, let's say oil cannot go. So basically the gas, the retail gas price cannot go above 3. Okay. Now down the line, the problem will be, okay, how are you paying for this? If you're printing, inflation will eventually come back. But in the short term, it is a good pressure. What it will do is it will do so great things in the very short term. Okay, so that's a good pressure, right? So when I say pressure, does not mean pressure is bad. Pressure basically means it's think of it like there's a hot balloon, and then the air is the pressure that's building for balloon to even take off. Now, to figure out which side it will take off, we gotta go to the next step. So first, the pressure is essentially the main reason why, you know, I'll let me just bring you this this image and it'll help you. Give me just one sec. Suddenly the charts are gone. Wow. Oh, okay. Here we go. So what you're seeing on the very first layer, okay, that's where the pressure builds. So think of it like that's where all of your earnings, your positioning, your CTAs, your you know, vol target funds, your flows and policies, rate cuts, all of that is all just noise. Okay, noise meaning not like a day-to-day noise, but let's say day 2, 3 or 4 month. Okay, unless let's say there's a regime shift. For example, the last time the Fed truly changed a regime was when they first adopted average inflation targeting, AIT, right? So that was a regime shift. Otherwise, everything else is just a noise. Like rate cut, rate hike, just noise. Noise in a sense that it does not change the regime. What it does, it basically, it's just a pressure. Okay, it's a pressure that it will eventually, the air will basically will push that balloon somewhere. Okay, so that's the first layer. The second is the constraints. Now the constraints are a little tricky. There sometimes it looks like it's a subset of pressures, okay, but sometimes it's a complete different thing. For example, coming back to, let's say again to the stimulated example, that what if Trump announces that he will be blocking, or he'll just, you know, have a restriction on the gasoline price that it cannot go above 3%. Okay, now the constraint will be typically there will be a negative one, which is, okay, who will be paying the price? Well, Fed will be printing the money. Okay, that's a good constraint, but what about, then we would have to like track when the inflation is about to rise because of this money supply that will be hitting the market. So there will be multiple constraints. So even when I use the word constraint, it does not automatically mean negative, because there's sometimes good constraint, then there's sometimes negative constraint, meaning sometimes you can have a situation that if there's a pressure building, a negative pressure, and then there could be a constraint that can offset its potential energy. So for example, you have, let's say, a pressure building because inflation is rising, so the Fed can jump in and, you know, start rising rates. So that would be a constraint to calm down the pressure. Okay, so again, both the times, just because the words are like that does not always automatically mean pressure or constraint are negative. It can be positive. You have to really see things from a lens of this framework, right? Then the trickiest part comes in the beliefs. Now, since it's a belief, there's no science behind. I believe this model works. You may believe, well, let me try this model for a few days. So I could be at plus 50 in terms of, if I quantify how much I believe, I'll say plus 50. And let's say if you're new to this, Okay, I respect you. Let me try this out for a week. And then, so you are at like flat, like zero. Then people who literally hate on me because they have blocked me, they'll be at negative 50. Like, I don't trust this, right? Then there are something I call the tourist, who are silent absorber. They won't appreciate, they won't not do anything, but they will always around my content. So those are plus 25. So each belief has a different score, right? Now the problem usually this is the most one of the second most important thing, and the biggest trickiest thing to figure things out, because you have to model these things. Since it's a belief, so this is where most hit and errors usually happens. But the belief is essentially what we do is basically understand who owns the bag. Who owns the bag, meaning once you have understood the pressure, once you have understood the constraint, right? There will be a point when the gas will leak or the air will blow, right? So who will be first one to get hit? Now here too, when I say it will get hit, it does not mean it will only on the downside. It can also be on the upside, right? So knowing that person is so important. That's why when you're like, chasing based off price action, how will you know that car is a truck, not a car? What if they're driving a sports car, not a, like a cheap car? It is so important to understand who is that institution who's doing this, because each of their tactics is very different. Like their motivation of doing things is different. The way they do it is very different. So knowing this layer is very important, right? And then the last one is the regime. This is where the structure happens. For example, if I take this example of inflation break-evens, I posted a year and a half ago. It is based on regime. The structure never changes. The belief it changes, but very slowly. But what changes is the constraint pressure. It changes every day. Okay, some of the pressure might stay with us. For example, we were in a rate cut cycle from 2021 to 2023. Now we're in a rate hike cycle. So it's going on for 2 years, right? But sometimes you'll see in months it will take a back seat. Sometimes it will take the front seat. Point being, these things changes. What does not change is the structure. That's why when people ask me, okay, where do I see market going? Well, you're asking me for a prediction which I cannot do, or not just cannot do. My model does not have the ability to predict anything. But I don't want to be vague, but what I can say is structure never changes. Meaning, the regime, when the regime is set, okay, let me just go back to my metaphor before I create some trouble for myself. When I decide to go from New York to LA, okay, and let's say there could be multiple of storms or problems that can come along, which is my mom can call me, my mom can ask me for pick up something, I can get into an accident, I can get into some sort of a traffic, I can bump into something. There's so many variables that can pause my outlook, or more so the timing on when I want to get to the LA. It does not mean I'm not going there. And even if that is the instance where because of some reason I need to literally U-turn, the best part, when the regime shifts, we get to know months before. So we're not like late in the party. So that's why the model is 24/7 working. It's a surveillance thing. So when the regime changes, we will know way before, to the point where we feel like we're wrong. So the best part is regime, first of all, does not change. The structure always remains the same. What changes is the first and the second layer. Everything else is like quite calm. It doesn't really move a lot. So to sum things up, the model's job is not to predict anything. The core job is to basically not get surprised. If markets are going up, we need to know why already. Like, we're not going to wait for market to do the move and then we look for, for the reasons, like, oh, it's because of this, oh, because of that. We don't work on that assumption. What we do is, this model helps you to, as much as it can, lower the chances of being surprised. Now, it can be both on the up and the downside. Like, you'll be prepared to know why, where, and how much will it happen. Okay, so that's the goal. We're not trying to predict that what's tomorrow is going to happen. What will be the NFP? What will be the midterm elections? These are just small little things that can create a distortion, but the structure will always remains the same. So in the regime side, essentially, just like a business cycle, you have like a trough, then a correction, distribution. That is the exact same thing. We just need to understand where are we in that regime. You have expansion, repair, distribution, and transition. So it's the same, and you just need to know which side of the board you are, because that will help you to understand the belief system. Because for a big institution, they don't trade day to day. They trade in quarter or even years to years. So it is important to understand these two things, which is the most time consuming and trickiest, but that's where the true alpha is. It's something you can actually rely upon. So I hope you get the basic, like a gist, what this is. So right now, if we talk about when people join, this is what I say. There will be a lot of information that you might feel very overwhelming. So what you have to focus is on, we just talked about 4 layers, right? I just want to add one more thing. The model has a vast amount of information that goes in. This product I just launched, like literally this week. For the Indian clients, it was launched today. This basically walk you through the process of how these patterns are emerging, right? But it is only covering 33 to 35% of the overall model. What is not covering is the third and the fourth layer is the most, as I mentioned, it takes a lot of time. Like sometimes I take months to figure out things, because the amount of information that goes into those layers. So first you would need to have some sort of a background that understand cross assets, how the money flows from one country to another, and then how it does, who protects it, what is their reason, why they're doing it. Like, you need to understand the markets, the economics, and that country's economics, and so forth and so forth. So that part is like I don't like openly talk about, but if you understand this framework, this is way, you'll be way ahead of most people when it comes to like understanding macro. So when you first come, this is what I say. There's 4 layers you have to understand. The first thing is, where is the pressure building? And are there any constraint? There always will be constraint. Now, constraint does not mean negative. It means it can create that pressure to more balloonify. I mean, that's not even a word. It can magnify, or it can pause it can delay its reaction. For example, right now, that's not even a good example. I'll just give you an Indian example, because I've been very much lately involved. So right now in Indian market, there is just so much things happening on a fundamental basis. You have 50% tariff, you have a nominal GDP declining, you have sales declining, you have earnings declining, but real GDP going up, right? So there's a lot of divergence happening, and the only thing that is basically delaying all these pressures, there's just so much money in the DII community, because people just started investing. It's like, you know, just like very recently, like post-COVID, they even heard, well, we here we don't even have something like a TFSA or 401k yet. Just think about what the US had back in 1990, like when they first were introduced to the mutual funds. That is the era we are in. Like people are becoming more literate that savings account, FDs will never get them anywhere. Like we won't be able to beat inflation. So people started investing. So this is like a very first, the layer, or let's say the wave. People are heavily coming into the market. So there's a constant bid from these guys. So it automatically, synthetically creates a bid in the market. And this constraint is a good one, right? Because it's supporting all the outflows, all these FI selling, all the negative factors. It's just offsetting all of it. It's just delaying the reaction. So it's a good constraint, right? So right now, from a US standpoint, you have, this is first of all, since US is a vast market, I mean, this is literally the bedrock of all of the markets. So it is split between, there's two types of scores. There's a day-to-day score, and then there's a global score, right? Now, the day-to-day score, right now, the pressure is coming in from the earnings. We saw what happened from Microsoft, right? And then the Capex. Capex as in, there's two types of fear. Well, technically a little more than two. Let me actually show you without making you too much into like overwhelmed. But just yesterday, we've had Microsoft shocking its core Capex thesis, right? There was a jump from nervous to broken, right? We all, like, I don't want to get into the earnings side, but I'm sure you must have, if you're active on the markets, I just don't know how can you miss that information. That was like literally everywhere. So I'm assuming you have already read it. What happened? Because there's a lot of information I do cover. I cannot go on this little thing. The next thing is you have the dealer gamma. In a very long time, there was actually a big shift. If you remember yesterday, S&P 500 had a sudden correction, and then of course it reversed back. But that basically caused a big shift between all of this positive gamma that was supporting the market. It reduced to from 20 billion to 4 billion. So there was a big chunk to absorb shocks was gone from the market. So if, let's say, something like that were to happen today, it would be negative for the market basically. Then you have systematic selling happening. People, you saw 10% correction on gold. Of course, it has nothing to do with this, but point being, the dealers are exposed to every type of risk. Sometimes when they cannot find enough, let's say, if I'm a dealer, let's say, and I see the zero DT will finish in an hour. This is a very bad example. But sometimes, let's say in a forceful situation, for example, back in April 4th, if you remember, if you look at all the global markets, if you look at their charts, you will see a big correction. They all look almost identical on April 4th, right? Although they all came back at a different pace, depending on the positive factors that they have had it of their own. Point being, there's no science to explain, but people who are involved into this, they'll understand. And then you can also observe through empirical studies. For example, when there's a risk off, like a serious risk off, a situation happening, you see something happening in X asset, or in a market, can create a ripple effect in different countries. Well, one science behind this is that, let's say, if those two countries were heavily had an exposure on global funds, like the passive funds, like MSCI's index funds, then obviously if there is a redemption hitting on their desk, if it's $100, so whatever your weightage, for example, in MSCI EM, India holds almost 19%. So let's say somebody puts a sell order on MSCI EM for about $100, automatically $19 will be coming out of the India. Like, that's just how the passive thing work, right? So that also was playing in the background because there was a lot of money, the market cap basically were reduced. Then of course there's a lot of like technical things, but there's also positive things happening. You have tariff related things have almost gone, because this section basically tracks like a timeline, like day by day. That's why there was a time then this Iran thing was literally at the top, but now it gone to a point that it's showing us a green, meaning it gone below the threshold that it's no more negative now. So that is a good pressure, right? If there's no wars, obviously the oil would potentially will be coming down. You will not have a risk off situation, so market can focus on other things. Then rates, there was a time when there was the thing that US may attack, that's why the oil went up. And then of course if US is going to attack, that means it may have to increase their money supply, that means the rates up, right? So that is basically pulling back. And we can see, because that's when on Monday when I say I'm long bonds, so I went long when the 10-year was at 4.29. Right now it's 5 basis point down. So that it is a good pressure, right? So there's flat pressures, there's negative pressures, and then there's positive pressure. This is just day over day, right? And then there's global pressures, like we have like switch on long-term pressures, okay? Now here, what we're seeing, I don't have the full list here, but essentially the big pressure in the market is the question of whether all this AI Capex that have taken place, whether or not will turn into any earning growth, or is it even sustained? For example, when I was watching this Davos conference, and the BlackRock CEO pointed out this one thing, that if the chips are being upgraded every 3 months, well, it is obviously it is just not sustainable. Like, how can you spend so much money which only has a utility for 3 months? So it is going to be expensive, right? So there's two questions. Number one, will all of this turn into an earning? Second, if yes, then how quickly? And then, does it really require to be upgraded every 3 months? Because that will be extremely expensive, right? So that's a long-term pressure. Like, it is something that will be with us for years to come, right? The other one, like for example, the VANA is, I mean, just by the arithmetic itself, if you are this is a type of a risk. It is, market adopts to it, meaning it is not really like a constraint, but if you are long something, in the US there is more, people prefer a lot of option selling strategies. So automatically the VANA is a component. I'm sure Jim Gerson, which I strongly follow, he always talks about this flow. So this is a long-term theme that that take place. So right now it is not a big deal, but then as we get, today is it is a big deal, at least for today, just because we're going through some month-end flows. But usually it happens around a week before the monthly expiry. That's when this constraint starts to actually take the front seat. But it is red there because I have to quantify to conclude a pattern, right? But people don't really look at, this is just one of those a situation where, if you are smoking cigarettes, it is affecting your lungs. Okay, now it is on you how much you want to. So do you want to exaggerate, smoke a like a packet, or you just want to smoke like a one or two? I don't smoke, but I couldn't think of a better example that people have just adapted to the factor that it is just a thing which is always play like a negative for the from a market structure standpoint. And then of course there is always this risk growing. I think Michael Green always talks about the concentration part, which is what if all of these interconnection of AI and AI's ecosystem, what if one person fail, and what kind of like ripple effects it can possibly have is what the systematic is. Like the systematic guys, both on the passive fund size and then everyone who's exposed to that risk is holding the bag. So let's say, let me give you a stimulated situation. Imagine AI narrative fails because let's say people are not satisfied or they're not able to grow the earnings, and at the same time you need to update the chips every 6 months, let's say. So it's high capex, yet no growth in earnings. Market punishes you, earnings down, you cancel orders, so the next person gets hurt. So that's how the trend starts. There's no long-term constraint like anything to stop this. So automatically the pressure just goes with no constraints, strict to the risk, like who's holding the bag, who will start the sell-off. It'll be the systematic guys. They'll be the first one who will be like, okay, I need to get out, right? So the cascade fragility is quite high, but it does not mean it is going to happen tomorrow. This is not a timing tool. It is like if somebody at Google is tracking me that I'm going to travel to LA, okay, it does not mean just because right now at 12 in the morning, if I'm searching it up, does not mean I will drive the very next minute. They understand this. I may even drive 3 hours from now, maybe not even tomorrow, 2 days from now, right? So they'll just monitor, and once I will start driving, that's when they will start driving too. So this model cannot time the thing. We can just see, again, it all comes back down to the framework. What we're really trying to do is to not get surprised. We need to know what can happen both on the positive and the negative side. That's the goal. We're not trying to predict anything. We're trying to be not get surprised. Okay? So this is the basic framework. Of course, I'm just giving a very surface level like a thing because there's just so much that needs to go. But this is what's up. You know, this is something will be with us for quite some time. Quickly, I wanna take this conversation to conclude what we saw on the treasury yield, that what will take us there. So we need to go back to so right now on here are the consensus. You could think of it like how the consensus builds its belief. For example, if you are a Trump supporter, right, whatever he does, it will make America great again. Now that's a belief. Only time will tell, right? If you do not support him and you'll be like, he will fall, that's a belief. Only time will tell by the time his term gets finished, right? So as I mentioned, the third layer is the most complicated since it's a belief. There's no science, right? Whatever I believe may not be true for you. So what I try to do is literally follow each beliefs and its sub beliefs. Okay, so right now all of that, as I mentioned, the third layer is the most complicated, the most time consuming layer of the model. I'm literally just gonna read off my notes that there's so many believe, like just to kind of give you like a few of them. Give me just let me. So this is the okay. So this is just, oh my god, it is making me look freaking white. So this is a 100-page long report that model needs to sort of like digest, and then I need to go through each of the things so the model can get the best output. This is just for the US market. I have to do for each country I'm involved in. Like right now I'm heavily involved in Indian, US and Hong Kong. So this is almost like what, 73 pages for the US, something slightly less for the Indian, and then even more less for the Hong Kong. But this is the layers. I have to like really break it down things, and so I can put in the information so those patterns can happen. Like a lot of time people conclude like these are some technical patterns. I have nothing to do with technicals. The only time I would use technicals is when I want to plot the pattern, because my clients, my viewers, everyone understand the chart pattern, so I have to speak their language. I cannot speak about, oh, this is a pressure, this is a principle. Like, what the hell are you talking? Tell me, where do I buy? That's how they think and they interact. So just because I have to speak their language, that's when I go on the charts. So right now I'll just speak like the most common ones, because as I mentioned, it's a very long report. Give me just one sec. I'm literally looking into. Okay. I'm just thinking, okay, where do I start, because everything is important. Okay, so what I'm gonna do is basically jump straight to the like a structural evidence, because we're talking about treasury yield going to 50 basis point down. Now, of course, it's not gonna happen tomorrow. It's not going to happen unless suddenly you see heavy revisions coming, because we have we did not had the data from the BLS from many sources because of the government shutdown. Plus, I think by Saturday, if they do not find by both the parties, I think we're going back again to the shutdown. So the more we get in the shutdown, I think that part of the data will never be updated, and then suddenly you see that data point coming into the market, and that's why I think why I'm seeing that sharp sell-off, right? Again, a speculation, my belief, right? Only time will tell. But the evidence, if we speak about what are the chances of that happening, I'll speak in that sense, so it would justify why, right? So if I start with strictly related to the bond market, let me quickly jump to the bond market, because there's other pressures too in the market. Okay, So now if we look, okay, we talked about inflation swaps, which is the 5-year forward. Give me just one second. I quickly want to just see the charts. Okay. So we I just showed you when I first when I first started just on that. When I first started the stream, I talked about the 2-year, 10-year nominals and the 5-year forward swaps, which is the inflation swaps, right? That's basically market's expectation of where the inflation swap would be on a 5-year forward basis. When it is pricing a upward move, okay, what needs to happen is you need some sort of a inflation shock or a risk that the market starts to think inflation will go up. Now, most TV commentators wait for price action to happen and then they justify. What I try to do is, if the model is seeing it, why is it seeing it? So I basically do the same process but in a complete reverse, or like a mirror image. Instead of waiting for price action to tell and then justify, rather I do the opposite. That what is the path looking to get to that point? So you have the Treasury 10-year around 4.2728. You have real yields trading near 1.55, which is, and its difference is what the inflation swap is. If the rates were the issue, okay, yields would spike on inflation fear or crash on a recession. That is not happening. So the structural interpretation is that the rates are hiding by basically rates are in a kind of a dead zone, but it is still the problem because rates can be dominated by the growth and the inflation. Those are the two, let's say, factors. Now those two factors can be influenced by many sub factors. For example, Trump can announce certain policies that will lead to inflation, cut down rates, right? That's just one path. So just like that, there is a web of interconnection between these two factors that can potentially create the 10-year as a fragile, in a situation where it's very fragile. So the reason why it matters is it is a hidden trigger, especially in a situation when a lot of stars gets aligned. So this can basically put the fuel on the top of whatever the underlying problem will be, right? So the reason why the model is able to see this happening is because the odds of that happening is much larger. It's just a matter of time. That's why when I first created that chart, my job after that is to basically track by other models when it is going to happen, or if it won't happen, then why. The other model's job is to cover up if it's not happening. Let me correct myself. It is not about whether or not it will happen. It's more about, as I mentioned, the destination structure never changes. What changes is it can get very much delayed, and it may look like, what happened? You told me market will go to 20,000. Hello, I never try to predict something, and this is the type of criticism it only comes when people are not the part of the ecosystem, because they don't have access to the other models that allows you to see things before you feel yourself you are wrong. So the point, what I'm trying to make is the odds of rates going down are more likely than going up. In the meantime, eventually it needs to go up. Okay, as I've already shown you, if inflation swaps are going up on a larger time frame, the treasury yields needs to follow. So there's no doubt about that. It's just a matter of what happens first. So what the model is seeing, especially from a sense, the 10-year story is the fragile story. It is not a constraint. It is not a pressure. It is a, you could say it is being used as a symptom, but it is not a root cause. The root cause is, it could be the policy. It could be, it should be the policy, because again, whose job is to make sure the yields remain contained? Whose job is to, like, who even bring yields to the party? It's the federal, not the federal. It's the treasury, right? The treasury are the one who issue bonds, so they are the main reason. Then the second is, okay, well, if the treasury is wrong, who is trying to add more fuel to it? Well, it's the Fed, again, a different type of a government. So point being, following the government is their actions will define the pressure and the constraint, and then its symptom will be seen on the treasury. So the way it works is, the pressure and the constraint will be showing us what the Fed is doing, what the Trump is doing. The risk, who owns that risk? The bondholders, or anything that's associated with the 10-year, which is literally everything, because it's that's how you literally discount every little thing in the world. Even for the Indian market, there's a very big component that comes from the literally 10-year, right? So it's very important to see where it is going. So in the section 1 and 2, we will be constantly, as I mentioned, these things changes every day. It will be it will be the Fed. It will be anything about the treasury, whether it's about more borrowing, technical issues like repo. Their repo market do not have any money left. So if there's a sudden spike in the demand for those for those swaps, it can trigger a liquidity crisis. So all these things, again, as I mentioned, the first 2 layers are always constantly evolving. They are very high frequency in nature. What does not change is the fragility of the 10-year. It will be with us for a very long time. Until, if you could, please tell me if you can quantify, when do you think the US will figure out their debt problem? If you could figure, please let me know, because that is the exact answer, that when the model will kick out 10-year from being a fragile factor. If you cannot figure out, like me, then it is going to be with for a very long time. So that's how the framework really works. When I just showed you the things from October last year, it is not a prediction. It is a structure that I showed you. What will drive, or what will take us on that structure? The other model, like the monthly model, the weekly model, the daily model, right? So there was this, it was more of a case study of how this model works. Hopefully we were able to understand. See, I know it is a complicated thing. It is not easy. I don't even try to make it sound like it is easy. Trust me, it's not. I always say this. For the past 3 years, I've always worked. I have the amount of the right way to say this is the sacrifices I have to take. Like, I had to lose like a lot of relationship, like not just like a relationship, but like friends, right? I never go anywhere out. I just cannot afford to go out because this model requires a lot of time. It's a very time consuming thing, but I'm happy. I'm happy in a way that it's worth being, or give your time to it, because I can see the results. Right, and that's just my belief, and I hopefully I'm able to also transfer the belief, and also basically give you a different perspective, because simply I believe, even in the MBA, I also study the same thing. What I believe is everything is being taught on this assumption that the price dictates everything. Price is everything. Follow the price. Price will tell us everything. I do not buy into that. Okay, if it tells you everything, well, okay. I'll be the guy, you know, if you have an exam, I'll leak the exam a day before if you want, in that way. So that is it from my side. It's very late. I mean, I usually get up at 2 a.m., 3 a.m. I have not even slept yet. My new day is about to start. Of course, tomorrow is Saturday, because Sundays are working day here. So I was able to like do the stream, but yeah, this is more very time consuming. But hopefully will be, well, I just looked up at the chart. It is not done yet. So again, I'm constrained on showing you, but you know what? Let me just let me just show you. So this is when we were, you know, doing. Now here's the thing. When I first posted this chart, let me actually show you in the Discord where I posted, so you know I'm not just bluffing, because I never do. Let me walk you to the things where I actually post. Okay, so where is it? My eyes are burning so much that I barely can see things. Wow. Okay. Now here's a good lesson for you guys. When I post charts, okay, now as I mentioned, these are not prediction. These are structures. Even this is a day, by the way, this is a daily crystal ball, right? We have a daily crystal ball, we have a weekly crystal ball, we have a monthly, quarterly, long term, right? Multiple crystal balls, they all help one another because they all comes with a flawed. And the reason why the other model was created, because the other model, for example, let's say a long-term model's problem is the inputs that go into are very structural in nature, that it does not come every day. In most cases, it comes like twice a year. Okay, so imagine a situation, let's say, if I get the data today and then in just 2 days, there's some big shift took place that literally changed the regime. For example, the Trump announcing big tariffs across the board. And if I would have received the data just the day before, that means I'm not going to get the data until next 6 months. So my model will be reading this completely wrong, because the input that goes in a day before were suggesting this is what's up. So it assumed that, but it does not know the reality, because I never try to smoothen out data just to fit my narrative. I try to keep it candid, almost 95%. In economics, you cannot go above 95% confidence. Like there's no 100%. It's 95 is like the best. The only part I do the tweaking is, I mean, not necessarily, I should say I do tweaking. What I do is Monte Carlo. It's a stimulation that if I were to go wrong, this is the path will look like. So I'm ready to, as I mentioned, the model's job is to not get surprised. So if I'm wrong, I know how the path will look if I'm wrong. So I know when exactly I need to react, right? So when I first posted the chart, okay, so here is the chart. It was posted. Now what you have to pay attention to, since I started talking, so I was, of course my screens are open, but I did not do anything. Now what you will notice is according to this chart, I posted 11:25 a.m. EST, so it would be somewhere around 10 p.m. So basically like 3 hours ago. According to this format, okay, the structure should have suggested 6923 should be the bottom. Okay, well, first of all, never read this chart based off, oh, it's suggesting at 2 p.m. it will bottom out. That's not how you read. The x-axis has nothing to do with the pattern. The patterns have no ability to forecast time. It can take days, it can take weeks, not weeks, but since it's a daily crystal ball, so I cannot tell you when, at what time it will finish, when it will make the bottom. I have no clue. I am not the bank. I'm not driving. I am just watching them. So what if they choose to just chill and chillax, or like sleep, or go in circles? Like, just so you know, these variables are not something that I control. I'm more of a person who monitors them, rather try to do anything, because I'm helpless. I cannot do anything. So according to this chart, right, a lot of time people, the newbies, right, when they come, they would think, okay, this is the bottom, and boom. And then in reality, what happened is you have almost 20 points of a more of a move down. Now, this is where the personal skills comes in. How? Well, what you just saw is just like, as I mentioned, the 4-layer framework is just the 35%, 33 to 35% of the overall ecosystem. We've also have different models that gives you these level-based insights. Now, level-based insights is essentially, let me actually like show you why exactly 6,900 was the bottom and then the market reversed. First of all, I wanna also point to a very important thing. Look at the structure. The structure never changes. It does not matter what happened within your drive. If you bump into an accident, if your mom calls you, you will get to your destination. This is the point I want to make. When you think about these patterns, the pattern job is to draw a structure, not to predict a structure, but to draw a structure that this is what's up. This is the bank are trying to do. That is it. Now, if you're trying to see what car they will take, where they're going to fill the gas, how many people are sitting in the car, that's when the different models comes in, which is essentially like these type of things. Right now, the levels and this and that, this is where the magic happens. So when I like the pattern itself is not everything. It is 33 to 35% of a thing, but there's more than the patterns that is happening. As I mentioned, it's an ecosystem. They all help one another, right? So if you judge based on something from a lens that this model is predicting, you failed. You failed the basic principle of the model, that it's not predicting anything. So if you're looking at it as from a lens it's predicting, boom, you're failed. Not I failed. So that is it from my side. Hopefully we'll be able to do more of this, and you'll be able to get to know more, because this shit definitely works. So I'm assuming it will be a good motivation for you to keep coming and learning, and that's the whole the goal and the motivation. You can also be in our free Discord. There's a lot of things. For example, in India, we do Infosys case studies every day. Everything I share in the Indian free community. We also have the US based community where we share NVIDIA. So let me actually show you the NVIDIA, because that was actually a better one. So here we go. Where's NVIDIA? My eyes are just going haywire. Like, I cannot even see things at this point. Oh my god. Okay, here you go. So this is the news I was talking about. There's something big coming. I don't know what is it, but this is coming, right? So again, I'm just showing you a structure. I'm not calling a prediction, but yeah, this is the chart I was talking about. So this gets delivered in the free Discord, because we when people ask me for free trial, see, I don't have a free trial. What I do is every day I share NVIDIA for the US market, in Infosys for the Indian market. It is exactly the same. If you like that content, you will like the whole model. Simple as that. So if you are curious to know more about this, NVIDIA and Infosys, even just the curious, if you want to be a part of this community, there's a link in the description. You can just jump in right there. We do a lot of content. So where is this report? Okay, it gets delivered right there, and you might have noticed, like when I post before and after, For Nvidia, everything is literally in the free Discord, right? So you can click on it, you can verify. You should always verify. You should never trust me what I say. You should always verify your own eyes. That's the motto. So that is it from my side. I will see you guys in the next stream. Till then, you have a very good night. People on the east side have a very blissful evening, and